Economists at TD Bank now think house prices have even further to fall in the next few months. They had previously forecast prices would fall from the third quarter of this year into the start of next year by 5%. Now they expect that drop to double to 10%. Let's find out what has changed with Derek Burleton, Vice President and Deputy Chief Economist at TD Bank. Derek, thanks so much for joining us this afternoon.
My pleasure.
So what has changed in the time that you forecast a 5% decline and now 10%?
Yeah, a couple of things. The rates are higher than we thought. 5-year yields, I know they've come back a little bit of late, but they're up quite a bit from the prior forecast in the early fall. And the other surprise has been supply. We've seen more listings on the market. The supply-demand balance has shifted more towards weak balance, even buyer's territory. And I think the big story there, you can't just paint the whole country with one brush. Where we've seen the big jump in listings and a bigger pullback in sales would be in southwestern Ontario, the Ontario market in particular, and BC to some extent. Elsewhere, the conditions still are holding up pretty strong, and even in seller's territory in the case of the prairies, and even the Maritimes, conditions are still fairly tight. So unlike early this year, the markets are no longer working in sync.
I want to jump back to yields. We've got one of your graphs from the recent report that you and the team did at TD showing just how much yields have changed from April to now. And I wonder if you can just walk us through some of the factors that are keeping yields elevated at this point, do you think?
Yeah, when you look through the year, it's been there's no shortage of surprises. That's for sure. The regional banking crisis in the U.S. Came earlier this year and sent yields down in a hurry. There were a lot of concerns about a significant recession in the U.S. that would ripple around the world. I suppose the good news is that since yields kind of bottomed out then, we've had signs of more economic resilience. Some of the worries about the banking crisis has fallen or eased, and inflation worries have kind of ticked up along with the resilient spending, particularly in the U.S. So we've seen a gradual shift upwards in longer-term policy expectations. For example, if you look at the U.S. Fed, markets were thinking, we'd see 200 basis points in rate cuts through 24. Get that policy rate down to 2.5. Boy, things have changed since then. Now we're looking at somewhere in the order of sort of 4%, 4.5% by the end of next year. So quite a level shift in expectations. Even of late, we've seen some paring back in some of the rate concerns.
Let's jump back now to the regional picture that you're seeing, because I want to show another one of your graphs from the report, Derek, about the sales to new listings ratio and how you're seeing that lower in Ontario, in BC in particular. It seems like, a lot of the focus when it comes to the housing market and then the fallout from, what that means if these, borrowers have bigger mortgages and are dealing with those higher interest rates in those provinces mean for their spending capacity elsewhere. But just in terms of the demand picture, the listings that are coming onto the market in BC and Ontario in particular, that's where you're seeing the strongest uptick in listings?
It is, and it reflects in these supply listings ratios that we plotted in that chart. And one just doesn't look at the level of sales to listings. You look relative to the longer term average of that specific market, because some are just inherently tighter over time. But where we've seen sales to listings drop well below averages in Ontario and BC. In the case of Ontario, we haven't seen a sales to listings ratio that low since 2008. Whereas in BC, the picture is a little bit better. And then across the country, you're dealing with sales to listings ratio still around average and still what I would say are in seller's territory. So it is interesting. Now, what that means is that that 10% drop in prices from the third quarter that we cite into the report, that's really going to be borne largely in the Ontario market with a balance that soft. I would expect continuation of a downtrend in home prices. The spring of next year perhaps will be a time where we'll see stabilization. We are counting on the Bank of Canada to begin cutting rates in April. And even if rates remain higher for longer, as I was just speaking about, we see some scope for rates to come down next year, and that should help by the spring. And we've got a bit of a modest rebound in the second half of next year, both sales and in pricing. So it's not a very ugly picture. I think, to your point, I mean, there are a lot of concerns about mortgage renewals, about the economy overall, but we're still fairly optimistic we'll get through this without too many bumps and bruises. Resilience of the employment market. We do have a demand shock in the terms of many new migrants still coming to Canada, which will support both housing and the overall economy in terms of spending levels. And the U.S. economy is doing just fine. It'll weaken off a bit. But so there are various reasons to think that we'll get through this. But the key, again, comes back to the rates. If inflation comes down, Bank of Canada can start cutting rates, then that'll throw a bit of a lifeline to both housing and the broader economy. So much depends on the inflation outlook.
How challenging is it right now, Derek, to even really put your finger on where house prices are right now? I mean, I know we get the data on it and whatnot, but if there are if sales are down so much without houses actually changing hands in a big way, how do you really gauge what a house is worth in this moment? I guess
it's not easy. And I think it's not easy. I think the real wild card, I think it's easier to gauge the demand side. Where we're struggling a bit is on listings, because they've remained so low in Canada for so long. It's really been a North American trend. Households have just not been listing their homes in great numbers through the pandemic. And even before that, listings weren't that high pre-pandemic. All of a sudden, in the last 5 months, we have seen a real outbreak in listings. I was heartened a little bit by the last month's data in the Ontario region. We had a spike in September and then a little bit of a pullback in listings in October. But, is that just a slight pause before we start seeing more? We do know there will be more distressed households with higher rates. And we built in the expectation listings will march higher. But we don't predict a gusher. But so much comes down to the unemployment rate and the job market, which we think will bend but not break.
Derek, great to get